Um, Welcome, everyone. My name is Victor Wang. I'll be your moderator tonight. Today, we have two distinguished speakers to talk about AI in finance and how to identify investable signals from a fast-moving commodity market. Before we start that, I want to give you some background about this forum and the series. So last year, we started this series forum called Smart Future AI Empowerment Series. The first series was completed last year, and it was a great success. We did 6 seminars, and it was widely responded and very well received. And this year, we are going to beyond AI in biopharmaceutical industry to help us navigating the rapidly changing world because of AI. And this series are sponsored by 8 Chinese American professional associations. The main sponsors are the Greater Washington Area Entrepreneur Club and US Sino Innovation Alliance. And together we have CASDC, CBA, SAPA, the Johns Hopkins Club for Innovation and Entrepreneurship. And we also have the Montgomery County providing support to us, for which we are very grateful. In Series 2, we're going to focus on a variety of areas. Here are some of the topics we identified so far. The first one is going to be today, and then we're going to thinking of AI in personal finance and wealth management, career development and professional growth in the AI-driven world, AI and the human meaning, work purpose and the life after AGI, which means artificial general intelligence, AI policy, ethics, and global governance, AI trends, forecasts, and emerging opportunities. These are just current thinking, and actually we welcome any of your feedback and suggestions on new topics and speakers. If you have any suggestions, please reach out to us. So currently, it's tentatively scheduled on every other month at the 4th Saturday evening at 8 p.m. online. So this is January, then we have March, May, etc. So about 6, but we could have more in between if there's any urgent issues come up. Today's topic will be given by 2 distinguished speakers. One is Dr. Amir Azhar. Dr. Azhar is a recognized authority in energy, finance, commodities, and quantitative trading. He's best known for his influential 2017 paper, Reserve-Based Lending and Outlook for Shale Oil and Gas Finance, which was being cited by, among others, the Wall Street Journal, Federal Reserve Bank of the United States, and the leading industry studies. Dr. Azhar is the founder and CEO of Agentics Edge and a principal at Quantum Horizon Capital, a CFTC-registered commodity trading firm. Dr. Azhar holds a PhD in engineering from the City University of New York, a master's in international finance from Columbia University, and previously held senior energy finance roles at KPMG, SMBC, and TD. The second speaker is Kevin Ho. Kevin is an expert and a recognized leader in applying AI across finance and data-driven decision-making. He has held executive positions at Red Ventures, Upside, and Capital One, where he led enterprise-scale data modeling and AI initiatives. His proprietary algorithms have collectively managed portfolios with assets under management exceeding 1 trillion. In 2023, Kevin, together with Dr. Azar, deployed AI and machine learning systems in commodity trading. The automated strategies have achieved double-digit returns since inception. Kevin holds an MBA from Columbia Business School and a master's degree in computer science. With that, I give you Kevin and Amir. Amir, the floor is yours.
Thank you. Thank you very much for the introduction. Gonna try to grab the screen. Let's see if it works. Is everybody able to see my screen? Is it visible?
Yes.
Yes.
Okay, perfect. Well, again, thank you, Victor, for the introduction. Before I dive into what we are offering here, I would like to, for many of you, might already have some familiarity with the issue. You have seen in the movies, you have seen, I'm sure, some of your colleagues that work in banking and trading firms. So usually, there are a group of people, large group of people that collecting information on different kind of commodities. They aggregate it together and then produce reports on the direction of the market, how and why that direction going. So like back when I was in the banking world, I saw that all the time. And the question was that, can this be more efficient? Because by the time, let's say, the person who is analyzing a certain commodity is finalizing his or her report to be aggregated with another commodity, that they are interconnected, then some of the information will already stale. So the inspiration started back right after I wrote the paper in 2017 that maybe there are better ways to do this. And of course, the AI and machine learning was the way that the technology allowed for that to make it a potential solution. So that's how we started. We decided to focus on the fundamentals, not just the price, the fundamentals that drive the prices of, in this particular case, crude oil, and see if we can collect those information real time to the extent they're available, or as frequent, to the highest frequency possible. By that, I mean, if it is available daily, it has to be daily, or if it is available within a minute or seconds, that's going to be the frequency that is used. And then aggregate those information, understand the interconnectivity, and then build a system that can automatically identify price dislocation and execute on that, and put basically trade and then calculate profit on us and keep the record. So I'm gonna what you see on the right side, by the way, is a small view of our system, which on the left side you see the trading side component, and then on the right are the gauges and the indicators that we are using. I would like to see clarity. So we are not dealing with a black box here. We know why our system suggesting certain price dislocation or certain trades. So for many of you, I mean, we hear about commodities all the time, about oil. There is a lot of news all the time associated. But one thing that we need to remember, compared to equity or debt market, commodities market is not that big. In fact, is way smaller than those two. And even in the whole concept of commodities, you have both futures that I'm going to dive into next slide, and the actual physical. And they don't really add up to more than $10 trillion. So compared to equity, that is, all global equity markets are over 100 trillion, or bond markets that even 130. Equity market is similar to the FX market. And but still bigger than crypto. And within that commodities market, you have, of course, energy, oil, gas, and refined products. And then you have the metals and agricultural products and many others. And yes, the energy is the largest one. And in that energy, you have crude oil, you have gasoline, you have ULSD that stands for diesel and heating oil. And then we exclude electricity market from here actually. And then when it comes to crude oil, you have the benchmarks, WTI for the United States, West Texas Intermediate, and Brent for the North Sea oil, a UK benchmark, and that are used for trading. I would like to make sure that the clarity here that so you have from one end the physical market, and you have another on the other side, you have the futures and derivative markets. And approximately for every 1 barrel of physical oil, there is over 20 barrels of derivatives. So think about the amount of liquidity that's in the system, which are tied to that 1 barrel of oil. Gonna move to the next slide. So if you want to trade crude oil, and what do you do? So let's say you want to trade West Texas Intermediate. You need to know that the contracts are in 1,000 barrels. So, and that they are actually tied to physical delivery in Cushing, Oklahoma. What does it mean? It means that if you buy a 1,000 barrel of oil, one contract, then you have to receive the delivery unless you roll over your position. Basically, that means that you exit the position before the maturity. Fortunately, the rollover in the system, unless the time that the liquidity is very tight, is kind of a straightforward. You just basically are supposed to pay transaction costs. But what makes this different from a typical, if you're trying to model a stock or a bond action, this particular stock, you don't have a single ticker that you can just follow the price. So you need to convert to each month to understand the continuity that the price of oil has had. And you see in the bottom of this slide, let's say for 2026, there are different contracts. They're going to have different prices. And then when you are modeling, you need to take all of these things into account. And the price, of course, the front month, we call it for the first delivery month. So the deferred pricing of the down the road is going to be different. That's something that when you buy an oil ETF, the ETFs do it. They make sure that they roll over the contract and always before the expiration. And again, this is a monthly thing, and it expires a couple of days before. Depends on each month is different, but let's say between 20 to 25th of each month it expires. So what does it mean for commodity trading advisors like us and from risk considerations? When we do systemic trading, we need to make sure our system exits and definitely before the last trading day and everything is automated. And usually we have to exit while the liquidity is in decent levels, because when they closer even to get to the last day of the trading, the liquidity it gets reduced and exit could be difficult. So a little bit about our model, and then I let Kevin to dive into details with this. So basically what we did, we started looking at the historicals, built the model. Then of course the model has some daily calibration and real-time pricings, and of course the reporting component. And I would, Kevin, if you're available, you'd like
Amir, I'm here. Can you actually help me just drive the slides so we don't need to switch? Okay, cool. Yeah. Thank you, Amir. And thank you everybody to join today's evening learning. Good to have the audience that interested in such a topic. Before I move on, probably let's have a quick recap what Amir have mentioned so far. First, the financial product in today's discussion is commodity, more specifically WTI or crude oil futures contract with the ticker CL. So today, remember when you hear WTI, crude oil futures contract, or CL, across the discussion today, just treat them as same thing, same concept, same stuff. Second, just as Amir showing on the page, actually the next page, what we build is a closed loop system for trading crude oil futures, CL. It's not just a model in isolation, it's an end-to-end operating system from research to deployment to execution to monitoring. So the strategy can be run consistently and safely at scale. The entire system and each component was architected and implemented by me starting about 2.5 years ago. From typing the first line of code to deploying the pipeline and launching live trading, it was roughly a 5-month journey. Next page, Amir, please. Okay, this is component 1. Now let's zoom into component 1. It shows how we build the model and prove it works before we ever trade it live. We start broad on inputs because crude oil is influenced by many different forces. We evaluated many variables, both shown here and others not shown here, to determine which inputs are practical, reliable, and useful for our own specific modeling and trading objectives. For example, here, we evaluated interest rates because intuitively, you can imagine when interest rates are higher, that reflect high inflation, and that tends to make many things more expensive, including crude oil. Another example, we evaluated foreign exchange rates. And people may know that crude oil is priced in the US dollars. So if the US dollar depreciates against other major currencies, oil can look cheaper to non-USD buyers, even if the USD price hasn't changed, and vice versa.
I may add a little bit, Kevin, to this. This is very key. As Kevin mentioned, this is a very critical moment because we know certain relationships exist, but they may change and they may become direct relationship, may become indirect. And those are the components that needs to be taken into account. So you need to make sure that when you aggregate these inputs, the hypothesis is tested and back tested. Kevin, back to you.
Yeah. And also to be clear, today we're like making the presentation more for information sharing and education purpose. And very clear, we do not use every variable listed here in the final model. And on the other hand, not every variable we actually use is listed here on this slide. Just because a lot of things are just trade secrets. We don't want to disclose or mislead people in any way for caution. And once we kind of start with exploration of a lot of variables, next step, what we do is we explore what we call a model zoo from traditional machine learnings, for example, linear or regularized models and SVMs, and tree-based models like random forest and gradient boosting and deep learning models, among others. But our model selection criterion is important. We don't simply pick the fanciest model. We choose what is the most robust across many environments using walk-forward testing and regime testing. In simple language, that means we simulate how the strategy and how the model will behave over different time horizons and under different market conditions. Finally, we select the model that is explainable and economically intuitive, so the drivers make sense. We avoid black box surprises. And next page, Amir, please. And now continuing from the previous slide, a key way to validate that a model is explainable and economically intuitive is through attribution analysis. Attribution analysis answers a simple question: what inputs are actually driving the model's decisions and by how much? We use attribution to validate the signal logic, documents what is happening, and strengthen model governance. Practically, we check direction and magnitude, whether a variable is pushing the signal toward buy or sell, and how strongly. And we also check consistency across regimes and stress periods. If a feature only works in one narrow time window, it actually is a red flag. Just to be crystal clear, the attribution chart shown here is also for illustration purpose only. It does not reflect the actual variables used in our model, nor their true impact magnitudes. Next slide, please. And here's a component 2. Component 2 is the daily reset that keeps the system current. By close of business each day, the system refreshes inputs, re-estimates parameters, and publishes update settings for next trading session. Here you see the step 1 is just ingest and refresh, pull the latest market data through APIs, update future sets and signals, and validate data quality. And step 2 essentially is to re-estimate the key parameters and refresh thresholds and risk limits. And then step 3 is to publish. We save the calibrated parameters into AWS relationship data system with versionings. So there's a clear history of which settings were used on which day. Then the system is ready for next trading session. Amir, next page, please. And here's component 3, how we use the model for live trading. Essentially, the model we build and we calibrate each day is a pricing model. During trading hours, we stream live market inputs and continuously generate a model predict the fair value, i.e. the price for CL contracts, crude oil contracts. Our basic strategy is to act when the current market price deviates too much from the model's value, fair value. In other words, when the market looks like an outlier according to the pricing model. And the distribution graphic shows the intuition. We treat extreme deviations as outliers. If the market price is significantly below the model predicted price, that means the market looks too cheap relative to the model, then we trigger a buy/long entry. If the market price is on the other side, significantly above the model price, appears too expensive, we trigger a sell/short entry. So the core behavior is simple. We enter at the tails of the deviation distribution, where the mispricing is large enough to justify a trade. And also to be clear, the curve shape and cutoff amounts in the left and right tails on the charts are for illustration purpose. They do not represent the true distribution shape or actual threshold values used in our live strategy. Next page, please. So once the model flags an outlier and we enter entry order and the field, either long or short, we immediately follow with an OCO bracket order, which stands for one cancels the other order. We do this because we want to display predefined exit plan the moment we have a position. That OCO bracket contains two legs, two exit orders on the opposite side. On one side is a take profit limit order. On the other side is a max loss stop order. The moment one order fails, the other is automatically canceled. And that's why called one cancels the other. In plain terms, we aim to exit with a profit using the take profit limit order. But we also prepare for the adverse scenario when the market price moves against us. In that case, the max loss stop order caps the loss at the maximum level consistent with our risk policy. Next page, please. When the system is running live, it ingests market inputs, computes price and signals, places orders, and continuously logs both inputs and outputs to the back-end database. We can always query the database directly to retrieve this information, but for convenience, we also visualize the key metrics in the website data dashboard, as you see here. On the dashboard, we can see real-time trade status, positions, entries, access fields, and we continuously monitor risk metrics such as exposure and VAR, value at risk, which is standard way to summarize potential loss under normal market conditions. Next page, please. And this diagram ties everything together in the single architectural view. All services run on AWS, primarily on EC2 for deployment and compute, and on AWS RDS for storing parameters and logs. Each day after market close, a scheduler triggers the daily calibration job. That job pulls market inputs through APIs, recalibrates the model, and saves version parameters to the database. During the trading hours, an intraday loop runs continuously about every 10 seconds. In that loop, we pull live market data from the broker API, compute the latest model price and signals, and when conditions are met, send orders back to the broker automatically. Crucially, we log everything: model versions, pricing outputs, execution decisions, positions, fields, and risk metrics. This creates a durable audit trail and makes the system maintainable and governable over time. Next, please. So the final slide is the so what. We built the system, so what? The message is displaying the modeling plus hands-free execution can deliver consistent performance across market regimes. First, on modeling, we do explore the model zoo, as mentioned earlier, but we deliberately select variables and models that are robust, intuitive, and validated by domain knowledge, not just the most complex. Complexity is not the goal. Reliable behavior is. Second, on automation, the end-to-end system is a hand-free system in operation from live inputs to pricing to execution to embedded risk controls to reporting. That consistency is a big advantage and a super critical factor because it reduces the chance of human timing errors and eliminating humans' emotional decisions. Third, on regimes, this approach is designed to work in both bull and bear markets. The idea is to exploit deviations between market price and the model predicted fair value. So it's less dependent on the market trending up or down and more dependent on identifying and acting on mispricing with displaying the risk metrics. The chart on side shows the WTI, the crude oil price over the last 5 years, and marks when our live trading began in late January 2024, about 2 years ago. Even through a challenging period for crude oil, our strategy had been designed and validated both with live operation and with long horizon, walk forward backtesting to be resilient across different market environments. And that's it. And now we're open to questions and discussions.
All right. Well, thanks, Dr. Azar and Kevin, for the very engaging and concise and stimulating presentation. So it looks like we have a lot of time on hands. And so anyone on the Zoom meeting can ask questions, just open your mic and ask questions. But right now there's one from Haley in the chat box. The question is, can I ask how big is the electricity trading market?
Well, electricity trading market depends on where you are in the US, and it's different. We would call it kind of a different animal in terms of it has its own utility people that are playing with it, and you are either in South and Texas has its own, then you have Northeast, de facto, and natural gas and electricity market in the Northeast have some connections. At the same time, could be connected with diesel. It's something that it hasn't been the focus for us because it doesn't impact the price of crude oil directly or even indirectly as much as the other thing. It has its own universe. And also, it's not part of the futures trading.
Okay, thank you.
Sure.
Any other questions?
I would like to add something that I think is very important for our audience to, as a key takeaway. I think Kevin put some emphasis on that there is no human bias in this. And what does it mean? De facto, what we have built here, when our system says that the price is too high from where it has to be, it also calculates where would be the entry point. And at the same time, whenever it suggests the entry, it also calculates the exit point. So when we enter into a trade or our system suggests a trade, it does these two simultaneously from risk management perspective, which is very crucial not to allow. So we sometimes, Kevin and I are looking at the screen and we see that the price is trending, and then we never allow ourselves to override what the system is recommending in terms of the exit point to stay longer to get to a higher profit, because everything is back tested and calculated, and the system is built to be as rigorous as possible.
Thanks. That's a great point. Eric Lee has a question. Would you please explain a little about your model?
Eric, any particular part of it you would like to know?
Yeah, I try to see, you see, yeah, I think this is great. And where you use AI and machine learning, everything sounds very smoothly. And this in general, I guess for the audience, maybe can you at least spend a little bit time explain, how do you apply this stuff in your pricing model, and how to decide, not very in detail probably, but what's your fair price? How do you think the price high or low, in an AI way, based by statistics or, some other way, like for the.
Okay, I think we can, both Kevin and I can contribute to this component from different angles. Think about the left side, you see the inputs, right? And these inputs are the components that, let's say, impact the price of the oil in a meaningful way that is considered a key component of that price calculation. And when that price is calculated, then the question is that, is the current price of the oil above or below that? And if it is above, and it's significantly above, let's say X standard deviation above, it is considered an anomaly. So our model says that, okay, it is time to enter and short the oil price. And for how much? That number is calculated live in real time, and where to exit, as I mentioned in the previous component part, it's also calculated. In terms of the components, I think the components are on the middle. The model has different components, and including ranging from LLMs for sentiments to blending different components that are coming from the machine learning side. And to the certain level, we can provide details. Kevin, would you like to share your thoughts on that?
Actually, I was listening to what Amir was answering and also was reading through questions by Diana, Leo, and RAH, right? And maybe I just like trying to kind of, combine my answers to probably answer all of your questions in one shot, probably from different angles. First of all, forget about the model, right? Just remember what you're trying to do. So everybody knows, even grandpa, grandma knows, right? If you buy something, you want to buy cheap. Then later you wait, you can sell at a higher price, right? On the opposite, when something is very expensive, you don't want to buy, you want to sell because you sell first, you buy later, you can make a profit. So that's what we're doing here exactly. So the question is how you can detect the signal, whether the price is too high or the price is too low, how you tell. And now we come to the model list here. There are several ways to do it. Not sure like everybody's background. Are you very like familiar with statistical modeling or machine learning? But in high level, there are two categories of models. One category model called regression model, which is give you numerical variable, which means is it give me a bunch of inputs like market signals or whatever information you can gather and tell me what is the oil price, what is the right oil price, or another question is what is the right housing price at your region, right? First of all, you answer that question, and let's say if you know the oil price, what it is, what is fair, good oil price, or you know what is good, fair housing price, then you say, okay, I want to buy a house because this house looks really cheap. I want to buy the crude oil because it looks cheap. On the other hand, is you feel like house is too expensive and because your valuation tells you that it's not worth that much, you want to sell. Okay, same logic here. So the first type of model called regression model, which give you a numerical value, tell you, hey, the house worth $1 million in your region, give all the information you know. And we have a regression model may tell you, hey, the crude oil worth $80 given all the scenarios, all the situation right now. So that's one category model. If you use that one category model, then you compare what the market price is at with your model price, right? If the market price above your model price, you say it's expensive. The other way around is cheap, okay? This is the first category model.
So I tried to pull the midlife thing, by the way, sorry to interrupt. Kevin, do you see the screen? I'm trying, I pulled the data from our dashboard live. So
yeah, we're seeing the slide component one. Yeah.
We are not seeing your live dashboard.
You're not? Okay,
You need probably
let me
share entire screen or which window.
Let me share the whole screen. Are you able to see?
Yeah.
Okay. Okay. I think this helps covering the explanations that Kevin had.
Yeah. Let's go to some fundamental, right? I mean, like I just described the regression model type, and that's like in the example we show there, we have like a curve shape, we have tails, right? The tails basically once you have prediction, you can see if something fall into tail, that's outlier. That is based on regression type model, is it too expensive, too cheap, or just right. The other category model is like called logistic model or categorical model, right? You may have a tree model, random forests have gradient boosting, right? Which tells you it's not even predict numerical value. You just upfront you predict, okay, given everything, like here, I say this is expensive, this is cheap, right? Or think about another example, like if you're predicting a student whether can pass exam, you may say pass or fail, right? somebody can pass a physical exam, you may say pass or fail. That's kind of categorical, biological, like kind of category model. But anyway, but you can see also regression and the category model, they can convert to each other in some degree. And so, I mean, there are like a lot of model here, just different version of it, like some more deep learning, like a long, short memory, like all different models, right? And those like just different ways to help you answer question, because ultimately the question we want to answer is something expensive, something cheap, right? So I want to give you like high level of understanding, because once you understand this, you can evaluate the model and pick the right one to answer your question. And also saw a question about what the sentiment analysis can do or social media can do, right? I tell you, the sentiment or the social media does not tell you directly whether the oil price is high or low, is cheap or expensive. And the sentiment or all the social media information or the news, all the stuff through the large language model at the best is intermediate result into the model, which will help you predict the final output. Either your final output is the predicted fair value of the price of the something you want to predict, or it's like tell you right away in which category, cheap, expensive, or just right. But never the social media or the sentiment can tell you direct answer whether that's something you want or not, right? So I think those are like a few quick answers I'm seeing here. Let me also
So I
yes.
think I would like to add something like if you're looking for one single category or one single element to tell you where the price gonna be, that would not be an optimized solution, because depending on the nature of the events or nature of the market, those elements contribution can be dynamic and changing. I think there was an example though, right around the time that like over a year ago, I believe, that we had the situation. There was a day that it was on social media that there is an imminent conflict between Iran and Israel. That particular day, the moment that tweet was posted by someone from White House, oil jumped up and then it came back down. Can that be a constant indicator that you can use? As Kevin mentioned, you cannot just rely on that, and you cannot just use that as your, I would say, directional approach. Might have a video of that. Let me see. But we can meanwhile cover other questions.
Yeah, this is Dmitry here. Kevin, a question for you, specifically on this slide. So you've got different machine learning models here.
Yeah.
And it's a good list. It's a nice coverage for different models. So does your system employ all those models at the same time, or how does it work?
No, we don't. This is like early on, we tried many things. We evaluate different models, right? Whether they are robust, whether they have good performance, and also whether if we kind of dial back time, do the the work for the back testing, do they generate the meaningful results? And we explore a lot of things, models and variables. In the end, we don't use most of them. Okay, we pick a couple models and we combine a couple models input using certain weighted average of two model prediction and become our final model that we rely on to implement strategy.
Got it. Okay, that makes sense. So you explored multiple of them, but ultimately ended with a few.
Yeah.
You did mention deep learning. LSTM is a famous model, kind of well deployed. But from explainability standpoint, you mentioned you want explainability. Do I derive from that you ended up not using deep learning models because they're not explainable?
Yeah, I mean, Dimitri, you're right. I tell you the truth, we did not use deep learning model. It's not very intuitive, and the reality is it does not predict well either. We use deep learning model, like, they say, hey, can we predict the price movement for the next hour, like next X hours with a lot of variables? Because when people use deep learning, the behind the mind is, hey, there are a lot of things, there are a lot of inputs, they're like very intricate, they are very interconnected. It's really hard to figure out what does what. Let's throw into deep learning model. Maybe deep learning model can do the feature engineering magic inherently, right, in a hidden way. But at least in our case, I guess just because there are other variables, actually very much strong signals, that in that case is, the intricate, complex models in the end do not deliver better results, because there are so many stronger signals give us a much better kind of prediction, more direct relationship between what we want to predict, right? So in the end, we do not stay with the deep learning model.
Yeah, that's excellent insight, by the way, because in the end, you've got to consider different types of models, and deep learning may not be the best, despite what's there in the news right now.
Right.
Good point. Thank you.
By the way, I saw Alan Pan's question, right, about overfitting and maybe like overstaying the performance. But let me actually, explain what do we do with a model? What do we mean do? What do we mean by back testing? Okay, so that you can understand why we avoid overfitting by the way how we do it. So what we do back testing is we actually use 20 years history. We go from 2005, right? What do we do with 2005 is we consume a couple years data before 2005. Let's say today is January 1st, 2005. We consume all the data before January 21st, 2005. Then we build the model. We kind of calibrate the model. We get the model parameters. Then we use that model to do the trading for today, which is January 1st, 2005. We're not getting any information before today, right? But we're build the model. We build the model using that parameters, using that kind of prediction to do today's trading. Then we see, use that. Does the model suggest to buy or sell? What do we do, right? Maybe there's no trade. So that's what we do with January 1st, 2005. Then we move on to one day. Now, January 2nd, 2005. We use all the information before January 2nd, 2005, right? Then we make trading on January 2005. You can see, so on and so forth. So we do this kind of for 20 years back testing in the way that we're not cheating ourselves. We're not cheating, trying to presume or like overstate our performance, because everything we do is we only use information before today, and we build the model based on that. Then we use that information, make a decision today, right? We test how it works. So that's how we do the back testing, and that's the way we kill a lot of models because they cannot survive that kind of testing, right? And that's also how we do every day today. Monday, if market open, we're using everything up to today, actually up to Friday, right? That's how we do. I mean, yeah, I know, I've been working on the model for 20 years. I know, performance, overfitting is a big enemy. So that's something like, at least in principle, in theory, I know how to avoid it.
Shall we add one clarification? I want to make sure the audience know that even though this model is working every day, that doesn't mean that we trade every day. It is only when the mispricings happen.
Yeah, because by definition, all live do not happen every day. It's happen pretty rare, actually. Yeah.
Yeah, it's not that common. It maybe happen couple per month.
So Kevin, Amir, there's many questions still in the chat box.
Yeah. There are a lot of questions. I'm trying to see whether I can
quickly
read the question.
Let me just pick some for you. One from Demi. She's asking, where is the data source? How to data mine and scale data to implied to building models? So Demi, did I represent your question correct?
Can you elaborate on that? What do you mean by data source?
Yeah, it's data source. I mean where you trace this data. And then for the data miner, it's more important because data huge. I don't think you use all your data from your original resource. Especially look at the right side, left side. You have marketing, sentiment, news, and teas. And this part is, for my understanding, very hard for you data scale. And also we call the data miner. How do you do it? That's most. And for the modeling, we know how to you build, you already said. And right now, I'm not discuss with you detail about deep learning anything. I really catch up. I want to know for first step, it's master, how do you scale your data? And beginning, how do you data mine from the original raw data? Like you said, that news, teas, marketing sentiment.
So
That's my question.
yeah, I can answer. You know.
Yeah.
And
Okay.
are you directly link with the US stack or you exchange? Like example, your data is direct from the exchange
Yes.
platform. That's right. My
That's right.
question is, you have a link to real time. That's right.
Yes, API.
Yeah. And for your history, you have passed over the data. For all those data, how do you scale? How do you mine from the raw data to pull out data and also scale data? We call the label it. Yeah, that's my question.
Okay. Well, I'm going to touch on that, and then Kevin can dive deeper on. Well, most of the data that we use are publicly available, and basically the historicals and the live ones. So we have the historicals gathered, collected, analyzed, looked into them deeply, like anything that you see on the left side before we even considered including it. So we had a hypothesis on the subject matter expertise that we had, and then we tested with numbers. And then we work on the modeling side. And in terms of the how we gathered them, as I said, through the APIs. And I think, Kevin, do you want to add anything on that in terms of the?
Yeah, I'm actually a little bit surprised about this question because one thing is a lot of data, historical data, you can get those data for free. Okay, if you know where to get those data from, of course, there's a little bit of research. Even on news, tweets, all this stuff, there are a lot of APIs. We do not need to do the mining ourselves. If you just identify those APIs, some free, some not free, you paid by the usage. And on the news and tweets, you can also set certain filters, right? Certain topics you want, certain news, certain news filters, certain tweets filters. You can get those either historical data or the real-time data. Just a question about how much you want to pay for it, right? I mean, I think that's why on the architecture diagram I have something very high level kind of category. Nowadays, the system, a lot of things just system talking to system through APIs. So getting data is not difficult. I mean, we're not downloading the data. Initially, when we examine data, we download a bit, but later everything is pulled through the APIs. There's no manual involvement, go here and there. We automate the whole thing. If we want to use certain data, we just set up the APIs, we set up the filters, and so on and so forth. Does that answer your question, or you were asking something different?
It's kind of, I just want to catch your answer. You said that you have set up the filter for your data. From my understanding, this filter is kind of you scale the data.
No.
No?
The filter is more specifically on the news, on the tweets.
Okay.
Because the tweets is so many tweets, I don't know, billions of tweets.
Of course.
Maybe every hour. Yeah, we say, okay, we only care about the tweets about crude oil. We only care about the tweets, right, on the certain topics. Same thing for news. We only care about the news about the oil producer or certain geographic regions, right? Even for weather, I can give you example. We have weather, but weather, you can specify the weather by geolocation, right? You say, okay, we want to know the weather in Texas, in certain location. We want to have the weather in the middle of Atlantic, right? We can specify that geolocation, get the weather, because otherwise too much data, right? We have to narrow down to the things, to the data that we care about. Otherwise, we're like spending so much bandwidth doing things, a lot of irrelevant information. So we do a lot of filters.
I would like to add to that, because the key is not about what we put in the models. The key is about what we avoid putting that could push us to the wrong direction.
Yeah, that's I agree. Yes.
Kevin, there was a question about whether the methodology can be applied to other things like stocks.
We both have a strong opinion on that. Would you like to go first?
I think the simple answer is yes, but I tell you the truth, it's not easy. I tell you why it's yes, because I know people who do this. Okay, they're proprietary hedge fund. They are doing this kind of stuff in the stock space, because I know them. Okay, they are doing it, but the reason it's not easy is because for commodity, we just trade the kind of one ticker, and we can have a lot of volume because it's very, very like liquid. It's very, very heavily traded market. We just know one thing well. We just model one thing well. But I know people doing the stock trading do the kind of mid-frequency things like ours, or maybe high-frequency stock trading. They're not just trading one name, one ticker. They're actually following maybe 1,000, even 10,000 ticker simultaneously. Only very small fraction of those 10,000 ticker at the day have opportunity, right? What that means is to do that, they are very well capitalized. They have money to build infrastructure. They have like all the processing powers, right? They have people to monitor different sectors. In principle, yeah, you can apply the similar methodology to equity, to stock market, but then you have to follow thousands of tickers. And that's one thing. You need to have capital to do that. Another thing is also I heard from my friends when they do this 10 years ago, doing the stock trading, doing the like things like we're doing, they were making easy money. Now, not that easy anymore, because stock market, equity market is very competitive. A lot of proprietary trading firms are doing the similar work there. A lot of competition over there, right? I mean, in theory, you can do it, but a lot of competition, you need a lot of capital of doing it well. In contrast, right, the commodity, I think is less crowded. And overall, yeah, commodity trading firms are not that advanced yet, right? So that's why we did some equity testing, but we did not go further. Yeah.
Can I add a little bit to that? So as Kevin mentioned, equity market has its own idiosyncrasies. And then what you are dealing with is sometimes could be lack of liquidity for a particular equity. On the other hand, in commodities market, and particularly oil market, the amount of liquidity and the leverage that you can get for a meaningful return is much more favorable. And many of the big, even Ray Dalio started with commodities market because that's a better market to when you are dealing with certain kind, you want to understand the macro. You're using fundamentals, and those fundamentals are important inputs for our model. And with equity market, things could be slightly different and require a stronger infrastructure. Sometimes even in some cases, when you follow a lot of tickers at the same time, you need to be also closer to the exchange for the execution. Some of them have higher frequencies for the trading. Yeah, so there are a lot of components that require strong, let's say, larger infrastructure.
So I have a question. So your guys is not a high frequency trading, right? For the commodity stuff.
In theory, high frequency trading means that you are trading within seconds.
Yes.
And no, we are not trading within seconds. Although we evaluate, we are monitoring the price, and in every 10, 11 seconds, that's how our frequency. We can go even more. But for the type of opportunities that we are looking for, we realized that we started from a minute, then we realized 11 seconds is the optimized range. I would like to mention that high frequency traders, they do not necessarily identify best opportunities. The only reason that, or the main reason they make money in high frequency is because the transaction cost is lower when you trade a lot. They provide liquidity for the exchange, and exchange at the end of the period send them a check that is going to be basically their profit, a refund on the amount of transactions they have. So we are fundamentally different. They go between the liquidity between the bid and ask. They're not going to look at all the fundamentals to do actual fair pricing. So whilst they look similar, our system and theirs, but in practice and in core, they are fundamentally different.
Yeah, that's very interesting. Yeah. And I came from different background. My background more fixed income, that's domain. But I was surprised. I heard maybe Kevin said you only recalibrate your model, after you do normally when I do my model, I do the calibration maybe, every like hour or something, try to make them, more predictable the stuff. But it's different if you try pricing some swap options or some callable stuff, probably you can say, okay, market maybe change what's the fair price you're thinking. But I was curious to know, for the commodity, like oil, how do you decide their fair price, right? So that's something I'm not, I didn't practice in that area, but just I'm very curious to know. How do you decide, the fair value in general? You can say, for the derivative, that's some way to describe it, right? But for the underlying, yeah, I just, beyond the regression, we can say it's high or low, I guess the fair price what everybody want to know, right?
Yeah, I mean, some of the information that are fed into our system are updated daily, let's say, at the end of the day. So that's why we definitely need to have recalibration at the end of the day to be ready for the next day, and also incorporation. And then every morning, Kevin, would you like to add to that on that side? So we make sure that there are mechanisms in place that make sure that our system is not drifting. And it's I would like Kevin to add to that.
I totally understand the question. My own background was also fixed income, probably like, not 80% of my 20+ years of financial career. And I also remember, like, when people doing fixed income, people did not do intraday calibration. Like from the very beginning, what people did is, hey, their calibration, maybe close the beginning, but later feel, later people feel, hey, their market become very, fast changing. Let's do like intraday calibration and so on and so forth, right? I think that's like, it's really given by the fact of how fast changing the market is. And given the commodity, we definitely can do multiple calibration in the middle of the day, maybe morning or evening, like whatever, we can set up the frequency. The reason we haven't done it yet, because number one is we didn't feel the urgency of doing that, right? Secondly, I kind of also feel that is, in some extent, even think about why we can identify outlier or on the market, it feel like the commodity is different from the fixed income, or maybe from derivative, like interest rate derivative market, from equity market, because commodity market, the crude oil is so much linked to the fundamentals, to the economic conditions, right? To the geopolitical factors, to some also to the to great extent by the hedging activity by big producers and big consumers, right? They are more fundamental. So in that way, is within the day, every hour, do the fundamental changes Maybe not, right? So that's like, we could try to calibrate the model every hour or maybe 3 times a day, and we can test out whether we have better performance. But just think about the fundamentals. I don't think their fundamental things have drive the difference, in the day or in the hour. That's number one reason. Number two reason is back to the, thinking fundamentally, why our model may detect outlier, or maybe in other words, why market have outlier opportunity existing there, right? It's not because we are smarter, our model can detect outlier, other people don't know. I think again, back to the fundamental, because this is at least what I think, the reason we see outlier is because there are big fish on the market, right? If they're all producer at a certain time, they have to hedge themselves. When they hedge themselves, they have to enter a lot of trades. When they enter a lot of trades, they have to disturb the market price for a short moment, just like somebody threw the rock, threw a paddle into the water. Then you see the rippling effect, right? Then very soon the rippling will be gone. The water surface becomes smooth again. I think that's why in my hypothesis, that's why we can identify outliers. It's not because we're smarter, our model is better, other people don't know the fair price. I just feel like there's unavoidable phenomenon, there's unavoidable activities will create such outlier temporary opportunities for us once a while. So that's what I think,
And I think last year, 2024, was a perfect year to see those activities. Like, for example, when a hedge fund, like people that were not engaged in oil before, or companies for financial reasons, come in and put let's say, $1 billion position in the oil market, that like a couple of days later, it comes to the news, and that they create those disturbances that Kevin was talking about, and those it's going to propagate throughout the whole system. But the question is that you see and capture that automatically as it comes in, and it lasts, let's say 40 minutes or an hour, and that's how the system positions itself for trades.
So basically, you said, this misprice, you catch it quickly, and then when the time come, you get another
We
side.
are always ready. It's
Yeah.
like I always think of it like a sniper, or like someone with a fisherman. Like, you're always ready for this opportunity, but
Okay.
it may or may not come. So it depends on other players, the bigger ones. Let's say for us, $1 billion position put outside of the normal activities of the crude market is going to disturb the market no matter what.
Right. So have you guys tried for like the gold, the silver? You see how they dramatically change recently?
That's a very good question. I'll let Kevin answer that. I have my own perspective, but I think there are certain markets that, like gold, silver, cryptos, that they are different in nature in terms of fundamentals. They are not necessarily driven by fundamentals of supply and demand. So, Kevin, would you like to add to that?
Yeah, I feel the gold and silver, they are not so much driven by the fundamentals as crude oil is, right? Crude oil is used for real economy. It cannot go to the sky, right? If it go to the sky, the U.S. government will do something, will make the price lower. It cannot go below maybe $30, $40, because once it go below $30, $40, most of the oil producer will close the door, because they have a cost limit, right? So I mean, in some extent, I feel like, the crude oil very, very driven by fundamentals, and a range of price is kind of controlled, managed by the U.S. government, or OPEC, a lot of organizations, right? So I feel like gold and silver are probably more speculation than fundamentals driven.
And remember also, I mean, yes, there is crude oil everywhere, but the final price of crude oil depends on the marginal barrel that is produced, let's say, in shale oil in the United States. And that we know that for certain acreages, that doesn't, the last 2 million barrels of the 100 million total production per day that is produced, that cannot drop in long term. Like, I can't give you a number. Like nowadays, you're talking about $60 total break-even cost. And that total break-even cost, yes, we can go because lifting cost is lower than that. But if the oil price drops for a long-term extended period below the break-even cost, you won't have investments. So which means that down the road, you're going to have shortage of supply that could push the prices higher. So we are moving within certain bands unless some unexpected things happen. So this is a real thing for the economy, and the governments and the economic player cannot afford to let it get too far from its fundamentals.
I remember their negative price, right? I remember there
So the
one time.
negative price, that was a very interesting point back when Kevin and I were working. I remember when Kevin was telling me that what happened here, so the negative price wasn't really negative price because of the price went negative. It was the cost of storage went so high because from fundamental perspective, oil is produced and consumed, and the storage, let's say you have about 14 days to a month storage. So storage going up, the cost of storage jumps up significantly. And when we didn't have gas because of COVID, the gasoline consumption and the refineries had already produced, the oils are getting produced. So we were running out of storage very fast. By the way, those people who put in trades and were able to source storage, they made billions overnight. So, and also what happened on that negative crude price day, I think was triggered somehow in a way that it was borderline legal. So I'm gonna stop right there because the players on that pushed that happen, they were doing things legally, but it was borderline.
Right. I think you're right. Okay. Now, how about the natural
there are
gas?
2 more questions there. We have 10 minutes or so. So like I see several from Alan Pan. One is, what's your typical trading frequency and how long do your trades last generally? And what's your win-loss ratio and winning rate?
Okay. So I think the trading frequency, and we mentioned that these opportunities do not happen every day. It happens a couple of times per month and it depends on the market. For example, in 2024, it depends on the nature of the volatility in the market. In 2024, because the volatility nature was driven by geopolitics. This year, we have more extreme volatilities. So, and typically we are an intraday trading system. And we exit by the end of the day, whether it is profit or loss. And then typically, I would say, Kevin, correct me if I'm wrong on that, we should, like our average trade, it takes around like 45 minutes or may go to a couple of hours. So that's the time that usually that impact that we are talking that causes the price dislocation disappears. So it doesn't last more than a couple of hours. Kevin, would you like to add to that?
Yeah, the signaling, the calculation runs about every 10 seconds. And to Amir's point is we do not trade every day because by rule, right, we trying to detect the outlier. Then again, by definition, you don't see outlier every day, every hour. So it happens once in a while, but it happens at a different at different frequency, at different market volatility environment. Then typically, that's the thing, you know, we detect the outlier, we enter trades, and most time the trades will be closed, right? Either most time we'll close, exit with a profit, maybe in the next 20 minutes or 1 hour, maybe 2 hours, okay? And if we are like, you know, if we're calling out the outlier, making the right trade. But the other hand is if we model outlier is driven by something beyond our understanding, right? Maybe driven by some news, some rumors we're not even aware. The market can continue go the opposite direction, and that will lead to we, you know, close our position at a loss. it's a loss, but it's kind of disciplining the loss, right? We capture our loss. We kept our loss as the maximum amount that we can accept by our risk policy, by overall risk management philosophy. And so the overall, we do not always win. Okay, we lose and we win. But the nice thing is, it's all about the ratio, about the probability. I think over the years, we look at our win and the lose, probably, it's kind of 7-1 or maybe 6-1. We make 6 times right trades, we make money, but then we lose money and if we make a wrong call, right? But also to be fair, when we lose money, we probably will be losing money of multiple wins, right? But overall, if we make 3 wins, 1 lose, we're break even. If we make 4 wins, 1 lose, we make money, right? But so far, we kind of mentioned early on, we probably more like 6-1, 7-1. Our threshold is 3-1. If 3-1, we kind of break even. 4-1, we make a little bit of money. And if above 4-1, like in reality, we're achieving 6-1, 7-1, and we make a decent profit. So that's kind of, the kind of stats we got so far.
So my question, so you are not making money just like say, like a traditional other trader, like a zero trader, they make the money if the market make, like from a gamma side. So you basically do not hedge. You just say catch the price different, misprice. Then you close when you feel the price is not good, right? That's what you said.
That's correct. Yeah.
So you're not hedging, like say, like alpha. If I'm trading some option, now of course I will hedging from an underlying. So for this case, if you're just trading future, you just try to figure out the misprice. You're not trying to hedging them. Is that correct?
No, we were not hedging. We just enter a position what we feel is a right bet, right? Then yeah, again, if we get the more wins than lose, and we're fine. Yeah, we're not hedging. Yeah.
Yeah, we don't enter the hedge to protect the position, if that's your question, because the whole system.
Yeah. Okay, I got you. So you're not like say get a lot of people they do the correlation because because the oil, gas, and some other things. So then you try to figure out some people try to take advantage between their mispricing or their correlation.
We thought about those. Okay, to tell you the truth, we thought about this. I tell you, it sounds like in theory it's good, but may cause more operational difficulty and maybe more risk. Because if we enter a trade on one side, enter another trade on the other side, it may help us, hedge or may help us lock the spread in theory, right?
Mm-hmm.
What I mean by in theory is because if we enter 2 trades, it kind of lock the spread, but we're not guaranteed to exit the 2 trades, right? Because if one side is not liquid, then we get stuck there, right? So there's actually risk. In theory, yeah, we should enter 2 sides, kind of lock the spread. But in reality, I mean, it's kind of more risky. Sounds like we do not
understand. Yeah. So kind of you just bet. I think that's good. You have 7-1. That's great. Yeah, that's I think above a lot of people probably. Yeah, even the big guy. Yeah.
Yeah, we're small. I feel like small has advantages. Small has advantages. Yeah.
Kevin, we want to make sure that the weighted average is not 7-1. It's because our losses are bigger than our wins.
No, I said that. I'm just counting the number of wins and losses. When we lose like maybe equivalent to 3 wins, right?
Yeah.
That's why we need to make sure the ratio is above 3-1. Yeah.
So are you guys in San Francisco? I saw you have a.
We're in Washington D.C. I'm in Virginia. Amir is in Virginia too. Yeah, we're local.
So there's this question from Q. He's or she's asking, as a newcomer, if I decide to trade commodities, which commodities would you recommend starting with? What would be your top 3?
I mean, it depends on whatever expertise you have prior to starting, because the way we started, for example, with crude is because of prior subject matter expertise that we had. We were able to test our different hypotheses. You need to have an insight to that particular commodity that you're targeting. both in terms of the fundamentals and the way it trades. That's my suggestion. Kevin?
I think, you know, it's very hard to make this recommendation. It really depends on expertise. Yeah, it depends. I mean, a lot of things you have to like just do yourself. You know, maybe somebody tells you it's a simple, it's something you should consider. But yeah, you know, when you do it, you may get a different conclusion. Yeah.
Very
Well, I
good
can tell
answer.
you one thing.
Not for everyone.
Depending on the risk tolerance that you have also, because different commodities have, let's say if you're in natural gas, you need to have a way higher risk tolerance. And your gains are higher, your losses are higher too, because natural gas volatility tends to go, like you can just see whatever is happening to price of natural gas because of the weather. Oil doesn't have that level of volatility or extreme volatility, unless there is a major war.
So there's a question from Daniel Chen. If your system can evaluate the fair price or mispricing, why do you have to close the position during the same day?
I can dive into that, but there are a couple of reasons. Because overnight, the fundamentals of a commodity market, and particular oil market, can change. And maybe from certain angle, it makes sense to hold on to the position. But also, the fact that many things can happen in the current volatile market, particularly from geopolitics perspective. That's the reason we want to basically cap our risk. And also there is another angle that you may wake up, like let's say your risk is capped at 10%, right? There is a risk that you wake up in the morning and the oil market has jumped significantly without your system having the ability to exit because there is not enough liquidity overnight. Kevin, your perspective on this?
I think first of all is it depends on what's our trading strategy. Our trading strategy is like we run this at mid frequency every 10 seconds. And we think if there's a mispricing at the moment and we take the profit and we leave, right? That's our strategy is what it is. And also to Amir's point, when it's way too long, like overnight, there's things could happen. And there's, you know, some events, you know, there's missile strikes, there are war somewhere, there are like all of a sudden there's an OPEC, the output report, the outlook, all this stuff can change the price a lot, right? We do not want to take that risk. And our strategy is like make money and run, okay? That's our strategy. We thought about, you know, doing another strategy, which is we do the fundamental research. We want to predict the oil price maybe, you know, 3 months out, 1 year out. But like it's good question. It's good research to do, but I don't know how to do it, right? I don't know how to predict the oil price, like, you know, 1 month out, 3 months out. So yeah, it's because once you do that, you have to make a lot of predictions on economic activities, on all the political risks. I feel like it's almost impossible, given, you know, probably it's always almost impossible, particularly right now.
3 months out is impossible even for the President of the United States.
Yeah.
I can tell you that.
Great answer. Q said, thank you for taking the time to answer my questions. It was truly eye-opening, a wonderful talk. I share Q's sentiment. We only have a few minutes left. Do we have any quick questions?